Good day, everyone. Trust you're doing well today. Today, we're talking about how wealth is really built during market corrections. Now, have you ever noticed something strange? The moments when people are most excited about investing are usually not the best time to invest. And the moment when people are most scared, those are often the moments that create the biggest wealth. Think about it. In 2008, people thought the financial system was falling apart. Then in 2022, people thought the world economy was shutting down. Businesses were closing, markets were crashing. News channels were showing fear, 24 hours a day. And yet, many of the people who became wealthy over the next few years were quietly buying while everyone else was panicking. So the question is, why does this keep happening? And more importantly, how can ordinary people take advantage of this moment instead of becoming victims of them? Now, let's talk about it. We need to talk about it because this lesson has repeated itself over and over again throughout history, and chances are it will happen again. The first thing you need to understand is that market corrections are normal, but every time one happens, it feels different every single time. Now, when prices are going up, people feel smart. Not only smart, people feel confident. People start believing prices will keep, rising forever. Then suddenly something happens. Maybe it is a recession, maybe it is inflation, maybe it's war, maybe it's, a full-blown financial crisis. And prices begin to fall. At first, people are calm. Then the losses get bigger and bigger. Now, at that point, fear enters into the room. People start checking their investment every hour. Friends begin to call each other. Social media becomes negative. The news becomes darker. No good news in the news at all. Then suddenly, everybody start asking the same question. What if, this time is different? That same question has been asked during almost every major market decline in modern history. And yet, history keeps giving us the same answer. Most corrections eventually end, most recoveries eventually come. But while the correction is happening, almost nobody believes it. This is where the opportunity comes from. Let me give you a simple example. Imagine your favorite phone normally sells for 500k. Then one day there is a massive sale and the exact same phone drops to 350k. Most people would be happy. They would see it as a discount. But when investments go on sale, people react differently. Instead of seeing lower prices as an opportunity, many people see them as a danger. That is because investment is emotional. Money affects our emotions, and fear can make smart people do very foolish things. This is exactly why many people sell at the worst possible moment. They buy when prices are high because everybody else is buying and talking about it. Then they sell when prices are low because everybody else is selling. Now they do this even without realizing they are doing the exact opposite of what creates wealth. Now let's go back to 2008. The financial crisis was one of the scariest periods in recent history. Banks were collapsing, millions of people lost jobs, entire companies disappeared. The stock market lost more than half of its value. Most people believed the damage would last forever. But while the headlines were screaming fear, some investors were quietly buying strong businesses at heavily discounted prices, not because they knew exactly when the market would recover, right? But because they understood something important. Great businesses do not suddenly become worthless because people are scared. Fast forward to a few years, the market recovered, then it grew even more. Now, those investments made during the panic period became some of the best investments of the decade. Then in 2020, history repeated itself again when the pandemic hit. Fear spread across the entire world. Businesses closed, airports became empty, cities shut down. People were genuinely afraid about what would happen next. Market crashed, investors panicked. But once again, some people were quietly buying, not because they enjoyed seeing prices fall, but because they understood that fear often creates discounts and discounts create opportunities. Now, this does not mean every investment becomes a winner. This is an important point, right? A market correction is not an excuse to buy anything and everything. You just gotta note that. Now, smart investors focus on quality. They look for assets that can survive difficult, times. They look for businesses that solve, real problems. They look for companies that people will still need years from now because they know that when the storm passes, quality usually has a better chance of recovering. And this lesson applies far beyond the stock market. Let's bring it home to Nigeria. Think about land, think about property, think about businesses, think about the Nigeria stock market. Think about every small opportunities around you. During difficult economic period, many people focus only on the bad news. That is actually understandable, at least from the perspective of survival mode. But some people are also looking for value. They are looking for assets that have become cheaper because others are desperate to sell. Years later, those same assets people were trying to sell off desperately often become worth much more later. And then again, the pattern is always the same. Fear pushes prices down. Patience creates wealth. Now, here is where many people get it wrong. They think successful investing is about predicting the future. They think wealthy investors have some secret information, but in many cases, that is not what separates them from everybody else. What separates them is emotional control. When everybody is excited, they stay disciplined. Now I'm talking about the successful investors. Successful investors stay disciplined. Now when everybody else is afraid, they also stay disciplined. They control their emotion. They do not let their emotion control their decision because they understand something most people forget. The market rewards patience more than excitement. And it also rewards discipline far more than intelligence. Think about it this way. Imagine two investors. The first investor spends every day trying to predict the next crash, the next rally, the next headline. The second investor simply keeps investing steadily into quality assets over many years. Now, history shows that the second person often wins, not because they are smarter, but because they are consistent. Consistency is actually the key word here because consistency builds wealth. And that brings us to one of the most important lessons from every market correction in history. We do not need to predict the exact bottom. Nobody can do that consistently. We do not need to know the exact day the market will recover. Nobody knows that either. However, what matters is being prepared for when opportunities appear. You just have to be patient and have a long-term mindset. And most importantly, understanding that fear is often loudest near the moment when opportunities are greatest. The next market correction will come. Nobody knows when. It could be next year. It could be several years from now. But history says it will happen. It's just inevitable. And when it does, the headlines will once again be negative. People will once again panic. Experts will once again debate and disagree. Social media will once again spread fear. And many people will once again believe the world is ending. But if history has taught us anything, it is that the biggest wealth building opportunities rarely arrive wrapped in good news. They usually arrive wrapped in uncertainty. They arrive wrapped in fear. They arrive when most people are just too scared to act. And that moment is why some of the world's biggest fortunes were built during market correction, not because those investors were fearless, but because they understood something that most people never learn. Temporary fear and permanent value are not the same thing. And those who understand that difference are often the ones who build wealth while everybody else is running away. So tell me in the comment section, which type of investor do you want to be like? Is it the investor who runs away or the investor who stays invested through the thick and thin? Now, if you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.